How big players trap the novice traders in stock market. Big players in the stock market can potentially trap novice technical analysis traders in several ways. 1. False signals. False signals, they might create false patterns or signals on charts to mislead traders into making poor decisions. False signals refers to a tactic used by big players in the stock market to deceive novice technical analysis traders. Here's an explanation. Big players, often institutional investors or traders with substantial resources, can manipulate the price and chart patterns of a stock or asset to create what appears to be a legitimate technical analysis signal. These signals may include patterns like head and shoulders, double tops, or trend line breakouts, which are commonly used by technical analysts to make trading decisions. Here's how it works. 1. Creating the illusion. These big players intentionally engage in trades or actions that give the appearance of a specific technical pattern forming on the price chart. For example, they may start buying or selling large quantities of the asset to mimic the beginning of a trend. 2. Attracting novice traders. As novice technical traders analyze the price chart and identify what they believe to be a genuine technical pattern or signal, they may decide to enter trades based on this signal. They expect the market to move in a certain direction, as suggested by the pattern. 3. Reversing the market. Once these novice traders have entered positions, the big players can suddenly reverse their actions. They might sell heavily if they initially appeared to be buying, or vice versa. This sudden reversal can lead to a rapid change in the market's direction, causing losses for the unsuspecting novice traders. In essence, big players exploit the trust that novice traders place in technical analysis signals by creating the illusion of a valid setup and then profiting from the resulting market movements when they reverse their positions. To avoid falling for false signals, traders should exercise caution, use other confirming indicators or methods in addition to technical analysis, and have strict risk management rules in place, including stop-loss orders, to limit potential losses if the market moves against them. Let's dive into it in more detail. 1. Creating the illusion. Big players in the stock market can manipulate the perception of technical patterns by intentionally engaging in specific trading actions. They do this to make it appear as though a genuine technical pattern is forming on the price chart. Here's how it works. Mimicking trends. These large market participants might start buying or selling significant quantities of a particular asset. For instance, if they want to create the illusion of an uptrend, they'll start buying, gradually increasing the demand for that asset. This rising demand can push the price higher, resembling the initial stages of an actual uptrend. Pattern formation. By engaging in these trades, they can cause the price chart to exhibit patterns that novice technical traders are trained to recognize and interpret. This could be anything from a simple moving average crossover to more complex patterns like head and shoulders or flags. Luring novice traders. As these patterns take shape, they attract the attention of novice technical traders who use chart analysis to make trading decisions. These traders see what appears to be a valid technical pattern and interpret it as a signal to enter a trade. Building trust. The big players create an atmosphere of trust and confidence in the perceived pattern. Novice traders often believe that these patterns are reliable indicators of future price movements and may not question their legitimacy. The key here is that the big players are not necessarily trading based on the actual technical analysis signals. Instead, they are strategically executing trades to deceive others into thinking that these signals are forming naturally. This illusion can lure novice traders into making decisions that align with the apparent pattern, only for it to potentially be reversed later by the manipulative actions of these large players. It's crucial for traders to be aware of such tactics and not solely rely on one indicator or pattern for their trading decisions. Diversifying analysis methods and incorporating risk management measures can help protect against falling victim to these deceptive practices in the market. Attracting novice traders. This step is where big players aim to lure novice technical traders into their trap. 1. Technical pattern formation. Big players intentionally engage in actions that create the appearance of a specific technical pattern forming on the price chart. These actions can include buying or selling large quantities of the asset in a way that mimics the beginning of a trend or a recognizable technical pattern. This might involve a series of transactions that seem to confirm the pattern. 2. Signal identification. Novice technical traders study price charts and various technical indicators to identify patterns or signals that suggest future price movements. When they see what appears to be a legitimate technical pattern forming due to the actions of these big players, they interpret it as a trading signal. 3. Decision to enter trades. Believing they have identified a genuine opportunity, novice traders decide to enter trades based on the signal they've recognized. For example, if they see what looks like a bullish trend forming, they may buy the asset with the expectation that prices will continue to rise. 4. Expectation of profit. Novice traders enter these trades with the expectation that the market will move in the direction suggested by the pattern they've identified. They may anticipate making a profit as the trend continues. 5. Emotion and FOMO. Often, emotions like greed and fear of missing out, FOMO, play a role at this stage. Novice traders might rush into the market without conducting thorough research or considering the potential risks because they fear missing out on what seems like a promising opportunity. In summary, at this stage, big players manipulate the market in a way that convinces novice technical traders that a genuine trading opportunity is unfolding. These novice traders then enter trades based on this false signal, expecting to profit, which sets the stage for the big players to exploit their positions in the next phase of the manipulation scheme. This is why it's crucial for traders, especially beginners, to be cautious, use multiple indicators or analysis methods to confirm signals, and not solely rely on one aspect of technical analysis to make trading decisions. Additionally, having strict risk management strategies, such as stop-loss orders, can help limit potential losses if the market moves against them. Reversing the market. This aspect of market manipulation involves big players intentionally reversing their trading actions after novice traders have entered positions based on the false technical pattern or signal created by these big players. Here's a step-by-step breakdown of how this works. 1. Initial illusion. Big players, often with significant financial resources, enter the market with large buy or sell orders. These actions are strategically timed to mimic the beginning of a genuine trend or pattern formation on the price chart. For instance, they might start buying a particular asset, making it seem like the price is about to rise significantly. 2. Novice trader reaction. Novice technical analysis traders, relying solely on their technical analysis tools and the apparent pattern on the chart, identify this as a strong signal. They enter positions in the direction they believe the market will move based on the initial actions of the big players. In this case, they might start buying the asset, expecting the price to continue rising. 3. Reversal by big players. Once a sufficient number of novice traders have entered positions and the price has moved in the desired direction, the big players suddenly reverse their actions. If they initially appeared to be buying, they now start selling heavily, or vice versa. This abrupt change in their trading behavior can lead to a rapid and significant reversal in the market's direction. 4. Losses for novice traders. As a result of this sudden reversal, the price of the asset may plummet or skyrocket in the opposite direction of what novice traders anticipated. This can lead to substantial losses for the unsuspecting traders who had placed their trust solely in the technical pattern they observed. In essence, big players take advantage of the trust that novice traders place in technical analysis signals and exploit their positions by intentionally creating false signals, then profiting when they reverse the market direction. This manipulation can cause significant financial harm to those who are not prepared for such sudden and unexpected moves. To protect themselves from falling into this trap, traders should exercise caution, consider using additional confirming indicators or methods, and implement strict risk management rules, such as stop-loss orders, to limit potential losses in case the market moves against their positions. Additionally, Gaining experience and understanding the broader market dynamics can help traders become more resilient to such manipulative tactics. Whipsaw moves. Whipsaw moves. Big players can induce quick, volatile price movements that trigger stop-loss orders, causing traders to exit positions prematurely, which involves whipsaw moves used by big players to trap novice technical analysis traders. Whipsaw moves. Whipsaw moves refer to quick and sharp price fluctuations in a financial instrument's value, often resembling the motion of a whip. Big players in the market can intentionally create these whipsaw moves to deceive and trap novice traders. Here's how it works. 1. Create false momentum. Big players initiate a strong, seemingly decisive price movement in a particular direction, upward or downward. Novice traders who rely on technical analysis indicators may interpret this as a genuine trend reversal. 2. Lure novices in. Seeing this apparent trend, novice traders may enter positions, either buying or selling, thinking they are catching a significant price movement. They might place stop-loss orders to limit potential losses or take profit orders to secure gains. 3. Sudden reversal. Once novice traders have committed to their positions, big players reverse the market direction abruptly. This can be done by executing large orders in the opposite direction or using various market manipulation techniques. 4. Trigger stop-loss orders. The sudden reversal often triggers the stop-loss orders placed by novice traders. Stop-loss orders automatically sell, or buy, an asset when it reaches a certain price level. When many of these orders are triggered simultaneously, it can intensify the price movement in the opposite direction. 5. Profits for big players. Big players capitalize on the price movement caused by novice traders' stop-loss orders. They can buy back at lower prices after a sudden drop, if they induced a bullish move, or sell at higher prices after a rapid rise, if they induced a bearish move, thus profiting from the trapped traders. In essence, whipsaw moves are a tactic used by institutional or experienced traders to exploit the actions of novices who follow technical analysis signals without considering the possibility of market manipulation. To avoid falling into this trap, traders should use stop-loss orders wisely, consider the broader context of the market, and be cautious when interpreting rapid price movements. Create false momentum. Creating false momentum. Big players in the stock market can intentionally initiate a strong and convincing price movement in a particular direction. This movement is designed to appear as a genuine trend reversal or a significant price breakout. Here's how this deceptive tactic unfolds. 1. Identify vulnerable traders. Big players often have access to substantial resources and market data. They identify areas of the market where novice traders or retail investors are heavily positioned. These novices typically rely on technical analysis indicators to make trading decisions. 2. Accumulate a position. To create false momentum, big players accumulate a substantial position in the targeted financial instrument. They may buy or sell large quantities of the asset, generating significant trading volume and price movement. 3. Signal the breakout. Once their position is established, big players may use various techniques to signal a breakout or trend reversal. This could include spreading positive news or rumors, issuing bullish or bearish statements, or simply executing large trades that trigger technical analysis indicators. 4. Attract novice traders. The convincing price movement attracts novice traders' attention. These traders may see the strong price action as a clear signal that a new trend is forming. They may start buying, if it's an upward movement, or selling, if it's a downward movement, based on technical analysis signals. 5. Confirmation bias. Novice traders often exhibit confirmation bias, meaning they seek information that confirms their existing beliefs. In this context, they interpret the false momentum as validation of their analysis, reinforcing their commitment to their positions. 6. Big players exit. Once a sufficient number of novice traders have entered the market and pushed prices further in the desired direction, big players exit their positions. This exit can be abrupt and substantial, and it's often the trigger for the eventual reversal. The result is that the false momentum, which initially appeared to be a genuine trend, collapses as big players sell off their positions. This abrupt reversal can lead to significant losses for novice traders who were lured into the market by the false signals. In summary, creating false momentum is a tactic where big players deliberately initiate a convincing price movement to attract and deceive novice traders into taking positions. Novice traders need to be cautious, use additional analysis beyond technical indicators, and consider the possibility of market manipulation when interpreting such movements. Lure novices in. When big players in the stock market initiate a strong and seemingly decisive price movement, this action is designed to attract novice traders, often those who rely on technical analysis indicators. Here's a breakdown of how this luring process works. 1. Decisive price movement. Big players intentionally make a noticeable price move in a particular direction. For instance, they might push the price of a stock sharply upwards. 2. Appearance of a new trend. This significant price movement creates the appearance of a new trend forming. Novice traders who use technical analysis tools, such as moving averages or trend lines, may spot this movement and believe it signifies a genuine and sustainable trend reversal. 3. FOMO, fear of missing out. Seeing this apparent trend forming, novice traders may feel a sense of urgency to participate in the market action. They may worry about missing out on potential profits, leading them to enter positions by buying if they believe the price will continue rising or selling if they anticipate a downturn. 4. Protective measures. Novice traders, wanting to manage their risk, may place stop-loss orders. These orders are designed to automatically sell the asset if its price moves against their position by a certain amount. They may also set take-profit orders to secure gains if the price moves in their favor. In essence, big players use their resources and market influence to create an illusion of a significant and sustainable price move, enticing novice traders to take action based on this perceived opportunity. It's important for novice traders to exercise caution and consider the possibility of market manipulation when they encounter such sharp price movements. Careful risk management and a broader understanding of market dynamics are crucial for avoiding potential traps. Sudden reversal. Sudden reversal. After novice traders have committed to their positions, big players orchestrate a sudden reversal in the market's direction. This abrupt change in price movement can catch novice traders off guard and is a key element in the whipsaw tactic. Here's how big players accomplish this. A. Executing large orders. Big players may initiate a significant volume of buy or sell orders in the opposite direction of the initial price movement. For example, if they initially induced a bullish move, they may suddenly start selling heavily. This flood of orders creates substantial selling pressure, or buying pressure, depending on the direction, causing the price to reverse. B. Market manipulation techniques. Big players may also employ various market manipulation techniques to facilitate the reversal. These can include spreading false rumors, using algorithmic trading strategies to trigger cascading stop-loss orders, or creating the appearance of strong buying or selling interest through fake order placements. C. Surprise factor. The key to the sudden reversal is the element of surprise. Novice traders who were initially confident in their positions, believing they were riding a strong trend, are suddenly confronted with a sharp price movement in the opposite direction. This surprise factor can lead to panic selling, or buying, exacerbating the price reversal. The goal of this sudden reversal is to trigger the stop-loss orders placed by novice traders, causing them to exit their positions at unfavorable prices. Big players can then capitalize on this price movement for their own gains, often buying at lower prices after a sudden drop or selling at higher prices after a rapid rise. This is how big players use surprise and substantial market actions to create a sudden reversal in price movement, a crucial step in the whipsaw tactic aimed at trapping novice traders. This abrupt change in direction catches traders off guard and plays a significant role in the success of the strategy. Trigger stop-loss orders. When big players induce a sudden reversal in the market after luring novice traders into positions, it often results in triggering the stop-loss orders placed by these novice traders. Here's how this process unfolds. 1. Sudden reversal. After novice traders have entered their positions, believing they are catching a significant price movement, big players swiftly reverse the market's direction. This reversal can be accomplished by executing large orders in the opposite direction or by employing various market manipulation techniques. 2. Price movement intensifies. The abrupt reversal in the market can lead to a cascade of price movement in the opposite direction. This intensified price movement can be quite rapid and sharp, catching many novice traders off guard. 3. Stop-loss orders activate. Stop-loss orders are automated instructions that traders set to sell, or buy, an asset when it reaches a specified price level. Novice traders often use stop-loss orders to limit potential losses. When the market moves sharply against their positions due to the big players' actions, these stop-loss orders get triggered. 4. Increased selling pressure. As stop-loss orders are triggered, they result in a surge of selling, or buying, activity, depending on the direction of the market reversal. If the big players induced a bullish move initially, triggering stop-loss orders may lead to a sudden influx of sell orders, intensifying the downward price movement. 5. Profits for big players. The big players capitalize on this intensified price movement. If they induced a bullish move initially, they can now buy back the asset at lower prices as novice traders sell in panic. Conversely, if they induced a bearish move, they can sell at higher prices as novice traders rush to exit their positions. In essence, triggering the stop-loss orders of novice traders becomes a profitable strategy for big players. They exploit the panic selling, or buying, that results from these orders being activated, allowing them to enter favorable positions and profit from the price swings caused by the trapped traders. To avoid falling victim to this tactic, traders should carefully consider their stop-loss levels, set them at reasonable and well thought-out points, and be mindful of the potential for market manipulation when interpreting rapid price movements. Additionally, staying informed about broader market trends and news can help traders make more informed decisions. Profits for big players. After inducing a sudden and sharp reversal in the market, as mentioned in point 3, big players capitalize on the price movement caused by the triggered stop-loss orders placed by novice traders. Here's how they profit from this situation. 1. Induced price movement. Let's say the big players initially induced a bullish, upward, price movement. Novice traders bought into this apparent trend and placed their stop-loss orders at lower price levels to limit potential losses. 2. Sudden reversal. Big players execute their plan to reverse the market direction abruptly. This could involve selling assets at a rapid pace, causing the price to drop sharply. 3. Triggering stop-loss orders. As the price drops, it reaches the price level set in the stop-loss orders of many novice traders. When these stop-loss orders are triggered, they automatically sell the assets at the current market price. 4. Buying back at lower prices, with a flurry of selling orders triggered by the stop-losses. The price often drops even further. This is where big players seize the opportunity. They can buy back the assets at these lower prices, effectively profiting from the price decline. 5. Reaping the rewards. Once they've bought back the assets at lower prices, big players can hold onto them or sell them at a higher price later when the market stabilizes. In doing so, they profit from the price movements they induced earlier. In essence, big players use the panic and forced selling triggered by novice traders' stop-loss orders to their advantage. They create artificial price swings to accumulate assets at more favorable prices, and subsequently, they benefit from the price recovery that may follow. This tactic allows them to exploit the inexperience and emotional reactions of novice traders in the market, turning their actions into profit opportunities. To defend against this, novice traders should exercise caution, set stop-loss orders thoughtfully, and consider broader market context before making trading decisions. Liquidity manipulation. Liquidity manipulation. By placing large orders, they can manipulate liquidity to move prices in their favor, then reverse the market once novices follow the trend. Liquidity manipulation involves the intentional alteration of the supply and demand for a particular stock or asset in order to influence its price. Here's how it works. 1. Accumulation phase. Big players begin by quietly accumulating a significant position in a particular stock. They buy shares over time without attracting too much attention. 2. Price manipulation. Once they have acquired a substantial position, they start manipulating the stock's price. This can involve placing large buy orders to drive the price up or sell orders to drive it down, depending on their desired direction. 3. Attracting retail traders. As the price begins to move in the desired direction, it attracts the attention of retail traders who use technical analysis or follow trends. Novice traders often see these price movements as opportunities and start buying or selling the stock, depending on the direction. 4. Profit taking. Once retail traders start following the trend, big players take advantage of the increased demand or supply to profitably unload their position at the manipulated price level. 5. Reversal. After they've exited their positions, big players may reverse their tactics, causing the price to move in the opposite direction. This traps retail traders who entered late and are now facing losses. In essence, liquidity manipulation exploits the basic economic principles of supply and demand to control the price movement of a stock. It preys on the inexperience of retail traders who may not recognize the manipulation until it's too late, resulting in losses for the novices and gains for the manipulative big players. To protect themselves, traders should be cautious of sudden and extreme price movements and consider the overall context of the market and the stock's fundamentals before making trading decisions. Additionally, setting stop-loss orders and adhering to a well-thought-out trading strategy can help mitigate the risks associated with liquidity manipulation. Accumulation phase. Accumulation phase. This is the initial stage of liquidity manipulation. In this phase, large institutional or professional traders quietly and gradually accumulate a substantial position in a specific stock or asset. They do this discreetly over a period of time to avoid attracting too much attention from the broader market. The key idea here is that these manipulators aim to amass a significant number of shares or contracts without causing the price of the asset to spike or drop dramatically. This accumulation is typically done through various smaller trades, often spread out over days, weeks, or even months. By avoiding sudden price movements, they aim to prevent other traders, including retail investors, from realizing that a manipulation scheme is underway. The ultimate goal of the accumulation phase is to establish a sizable position in the asset that can later be exploited for profit when they move on to the subsequent phases of price manipulation. This allows them to control a substantial portion of the asset's supply or demand, giving them greater influence over its price movements. Liquidity manipulation. In the price manipulation phase, after the big players have accumulated a significant position in a particular stock during the accumulation phase, they start actively influencing the stock's price to their advantage. This manipulation can take two forms, depending on their desired direction. 1. Driving prices up. If the big players want to profit from an upward movement in the stock's price, they may start placing large buy orders for the stock. These buy orders create increased demand for the stock, which can push its price higher. As the price starts to rise, it can attract the attention of other market participants, especially retail traders who use technical analysis or follow trends. These retail traders may interpret the rising price as a bullish sign and start buying the stock. 2. Driving prices down. Conversely, if the big players aim to profit from a downward movement in the stock's price, they may place large sell orders. These sell orders increase the supply of the stock in the market, potentially causing its price to drop. When the price declines, it can attract the attention of retail traders who see the falling price as a bearish signal. These retail traders may then start selling their positions or shorting the stock, further contributing to the downward pressure on the price. The key goal of this manipulation is to create the appearance of a trend that entices retail traders to participate. Once retail traders start following this manipulated trend, the big players can take advantage of the increased demand or supply to profitably exit their positions at the manipulated price level. As discussed in point 4, this phase highlights how sophisticated market actors can effectively control the direction of a stock's price movement to their advantage. The process of liquidity manipulation involves attracting retail traders to the manipulated price trend. Here's a more detailed explanation. Attracting retail traders. After big players have successfully manipulated the price of a stock in their desired direction, either up or down, the noticeable price movement starts attracting the attention of retail traders. Retail traders are individuals or small investors who are not part of institutional or large trading firms. They often make trading decisions based on technical analysis, following trends, or simply reacting to significant price changes. In this phase, novice retail traders observe the price movement, and many of them may interpret it as a trading opportunity. If the price is rising, they might see it as an uptrend and an opportunity to buy, hoping for further price increases. Conversely, if the price is falling, they might perceive it as a downtrend and a chance to sell, expecting the price to continue dropping. The attraction of retail traders is a crucial element for the manipulators because it adds more buying or selling pressure to the stock, further amplifying the price movement in the desired direction. It's important to note that retail traders, especially those new to trading, may not be aware of the manipulation occurring behind the scenes. They might believe that the price movement is a result of genuine market forces when, in fact, it's being orchestrated by larger players with the intent to profit. As a result, many retail traders enter the market during this phase, following the trend set by the manipulators, which can lead to increased volatility and trading activity. This is where the big players take advantage of the increased demand, or supply, to profitably exit their positions at the manipulated price levels, as explained in point 4. Profit taking. Profit taking, in this phase of liquidity manipulation, after the price of the stock has been manipulated in the desired direction, either up or down, the big players take advantage of the increased demand or supply created by the price movement. They start selling their accumulated shares at the manipulated price level to realize profits. This is a critical step for them because they are essentially cashing in on the price movement they themselves engineered during the previous phases. By selling their shares at this point, they can often make substantial profits, taking advantage of the buying or selling frenzy generated among retail traders who are now following the trend. It's important to note that the big players' goal is to exit their positions profitably, and their actions in this phase contribute to the maintenance of the manipulated price level. Once they've completed their profit taking, they may then consider reversing their tactics, causing the price to move in the opposite direction and potentially trapping late entrant retail traders who may now face losses. This is where point 5, the reversal, comes into play. Reversal. Reversal, after the manipulative big players have successfully unloaded their positions at the manipulated price level, usually after attracting retail traders to follow the trend they initiated, they may reverse their tactics. This means they might start taking actions that push the price of the stock in the opposite direction of the initial manipulation. For example, if they initially drove the price up through large buy orders, they might now start selling heavily. Alternatively, if they pushed the price down through sell orders, they may start buying aggressively. The purpose of this reversal is to catch retail traders who entered the market late, often after the price has already moved significantly, and who are now chasing the trend. Retail traders may have bought when the price was high, in a manipulated upward trend, or sold when it was low, in a manipulated downward trend, thinking the trend would continue. However, when the big players reverse their tactics, it can cause a rapid and sharp price movement in the opposite direction. This can result in significant losses for retail traders who bought high or sold low, as they find themselves on the wrong side of the market. In essence, the manipulative big players exploit the latecomers' positions for their own gain. This highlights how liquidity manipulation can be a trap for those who enter the market late and fail to recognize that the initial price movement was artificially manipulated. News and rumors. News and rumors. Spreading false or misleading news can influence traders' decisions and create buying or selling frenzies that big players can exploit. News and rumors manipulation. 1. Spread false information. Big players, such as institutional investors or market makers, may intentionally spread false or misleading information about a particular stock or company. This information can be about earnings reports, mergers and acquisitions, regulatory changes, or any other factor that can impact stock prices. 2. Create hype or panic. By disseminating this false information, they can create a sense of urgency, hype, or panic among novice traders. For example, they might suggest that a company is about to make a groundbreaking announcement or that a major scandal is imminent. 3. Trigger trading activity. Novice traders, often relying heavily on news and social media, may react impulsively to such information. They might rush to buy or sell the stock, thinking they're making a smart move based on breaking news. 4. Exploit price movements. Big players take advantage of the price movements caused by these novice traders. If they spread positive news, they might sell their own holdings at inflated prices. Conversely, if they spread negative news, they may buy at artificially low prices. 5. Profit from misinformation. Once the market corrects itself and the false information is revealed, big players can profit from the difference between the manipulated price and the actual value of the stock. This manipulation tactic is often illegal and unethical, as it preys on traders who may not have the experience or resources to verify the accuracy of news and rumors. To protect themselves, traders should be cautious about making hasty decisions based solely on unverified information and should consider multiple sources and conduct due diligence before acting on any news. Additionally, regulatory bodies work to detect and punish those who engage in such manipulative practices. The practice of spreading false or misleading information about a particular stock or company in financial markets. Here's an explanation. Big players in the market, which can include institutional investors, hedge funds, or market makers, intentionally disseminate information that is not accurate or is designed to deceive others. This false information can pertain to various aspects of a company, such as its financial health, earnings reports, potential mergers and acquisitions, regulatory changes, or any other factor that can significantly impact the stock's price. The goal of spreading this misinformation is to manipulate the perceptions and actions of other market participants, including retail investors and traders. By creating an illusion of a positive or negative development regarding the stock or company, these big players seek to influence the behavior of others, causing them to buy or sell the stock based on the false information. In essence, it's a deceptive tactic aimed at provoking specific reactions in the market that can be exploited for financial gain. It's important to note that spreading false information in this manner is often illegal and unethical, as it can lead to market manipulation and harm to unsuspecting investors. Regulatory authorities closely monitor such activities and take actions against those responsible when detected. Create hype or panic. Creating hype or panic in the context of financial markets refers to intentionally disseminating information, whether true or false, to manipulate the emotions and behavior of traders and investors. Here's a breakdown. 1. Hype. Big players might spread positive and exaggerated information about a stock or company to generate excitement and enthusiasm among traders. For example, they could suggest that a company is on the brink of unveiling a revolutionary product or announcing a lucrative partnership. This positive hype can attract buyers who want to get in on the supposed opportunity. 2. Panic. Conversely, these manipulators may spread negative or alarming information to induce fear and panic. They might suggest that a company is facing a major scandal, regulatory trouble, or financial crisis. The goal is to create a sense of urgency among traders to sell their holdings quickly, driving the stock price down. The key here is that the information may not be accurate, and its purpose is to provoke an emotional response rather than provide objective analysis. Novice traders, in particular, can be susceptible to these tactics, as they may not have the experience to critically assess the credibility of the information. Ultimately, Creating hype or panic serves the manipulator's agenda. They can profit by either selling their holdings at inflated prices when hyping a stock or buying at artificially low prices when causing panic. It's crucial for traders to remain level-headed, verify information, and consider multiple sources before making investment decisions, especially when they encounter sensationalized news or rumors in the market. News and rumors manipulation. News and rumors manipulation refers to the strategy of triggering trading activity among novice traders. Here's a more detailed explanation. Trigger trading activity: when big players intentionally spread false or misleading information about a stock or company. Their goal is to provoke a response from traders, especially those who rely heavily on news and social media for their investment decisions. The false information they disseminate can create a sense of urgency, excitement, or fear among these novice traders. For example, they might suggest that a company is on the verge of making a groundbreaking announcement or that a significant scandal is about to be revealed. The intention behind triggering this trading activity is to prompt novice traders to take immediate action in the stock market. Some may rush to buy the stock, thinking that they're making a smart move based on this breaking news, while others may hurriedly sell their holdings to avoid potential losses. This impulsive reaction by novice traders can lead to significant fluctuations in the stock's price. As a surge in buying or selling activity occurs, big players who initiated the false information can then exploit these price movements to their advantage. Either by selling their own holdings at inflated prices if they spread positive news, or by buying at artificially low prices if they spread negative news. In summary, triggering trading activity is a key step in the manipulation process, as it capitalizes on the emotional responses of less experienced traders to create price movements that can be exploited by those behind the manipulation scheme. Exploit price movements. When big players intentionally spread either positive or negative news about a stock, it often triggers a significant reaction in the market. Novice traders, reacting to this news, might rush to buy or sell the stock, believing they are making informed decisions. If the big players spread positive news about a particular stock, it can lead to a surge in buying activity, causing the stock's price to rise significantly. At this point, the manipulators can take advantage of this inflated price by selling their own holdings of the stock at a profit. Conversely, if they spread negative news, it can induce panic selling among traders, causing the stock's price to drop rapidly. The manipulators can then buy the stock at these artificially low prices, positioning themselves for future gains when the market eventually corrects itself. In both cases, big players use the exaggerated price movements caused by the reactions to false information to their advantage. Either by selling high or buying low, this tactic can result in substantial profits for them at the expense of less experienced traders who may be caught up in the frenzy created by the manipulated news. How big players profit from misinformation and market manipulation after the false information has been corrected and the true facts are revealed. Here's a breakdown of how this works. 1. Spread false information. Initially, these big players intentionally spread false or misleading information about a stock or company, causing the stock's price to move in a certain direction, either up or down. 2. Novice traders react. Novice traders, influenced by this misinformation, react by buying or selling the stock based on the false news. This can lead to significant price movements in the direction the manipulators desire. 3. Misleading price movements. As a result of these novice traders' actions, the stock's price becomes temporarily disconnected from its actual value. If positive news was spread, the stock's price is artificially inflated. If negative news, it's artificially deflated. 4. Manipulators profit. Once the true information is revealed and the market corrects itself, the stock price will likely move back towards its actual value. Big players then profit from the difference between the manipulated price and the stock's true value. For example, if they spread false positive news and the stock price surged, they might sell their holdings at these inflated prices before the correction occurs. Conversely, if they spread negative news, they might buy the stock at artificially low prices, and then sell it at a profit when the price rebounds. In essence, they profit by exploiting the gap between the manipulated price and the actual value of the stock, taking advantage of the confusion and panic created by the initial misinformation. This practice is not only unethical but often illegal, and regulatory bodies work to detect and penalize those involved in such activities to maintain the integrity of financial markets. Front running. Front running. Some institutional traders may front run retail orders, buying or selling ahead of them to capitalize on price movements caused by the influx of retail trades. 1. Retail trader places an order. Let's say a retail trader decides to buy a significant number of shares of a particular stock. They submit their order through their broker. 2. Broker's knowledge. The retail trader's broker, who may also be affiliated with a larger financial institution, has access to all their clients' orders and trading activity. 3. Front-running opportunity. The broker can potentially use this information to their advantage. If they anticipate that the retail trader's order will drive up the stock's price, they might execute their own orders to buy the stock at a lower price before the retail trader's order is filled. 4. Profit for the broker. By front-running, the broker aims to benefit from the price increase caused by the retail trader's order. They can then sell the shares they purchased at a lower price to the retail trader at the now higher market price, making a profit in the process. This practice is unethical and, in many jurisdictions, illegal because it puts retail traders at a disadvantage and erodes trust in the fairness of the financial markets. To protect against front-running, retail traders can consider using brokers known for transparency and ethical practices. Additionally, regulatory bodies often have rules in place to prevent such activities and punish those who engage in them. In the context of front-running explains the initial step in the process. 1. Retail trader places an order. In this step, a retail trader, who is an individual or small-scale investor, decides to buy or sell a significant number of shares of a particular stock. To execute this trade, they submit their order through their chosen brokerage account. In simple terms, this is when the retail trader decides to make a stock transaction by telling their broker that they want to buy or sell a specific number of shares of a particular company's stock at the prevailing market price. This order submission is the first action that sets the front-running scenario in motion, as the broker now has knowledge of the trader's intentions, which can potentially be exploited for gain, as explained in the subsequent steps. 2. Broker's knowledge. The retail trader's broker, who may also be affiliated with a larger financial institution, has access to all their clients' orders and trading activity. In this step, it's highlighted that the retail trader's broker has access to information about the orders and trading activities of all their clients. This information includes details about what securities their clients are buying or selling, how much they are trading, and at what prices. This access to client information can be valuable and potentially exploitable by the broker in the context of front-running, which is why it's essential for regulatory bodies to monitor and enforce rules against such unethical practices to protect retail traders. 3. Front-running opportunity. In this step, the retail trader's broker, who has access to all their clients' orders and trading activity, may recognize an opportunity to front-run. They do this by leveraging their knowledge of the pending retail trader's order and the potential impact it could have on the market. Here's a breakdown of this step. Information advantage. The broker knows that the retail trader intends to buy a significant number of shares of a particular stock. This information is not yet public but is available to the broker due to their role as the intermediary between the retail trader and the stock market. Anticipation. The broker anticipates that when the retail trader's large order is executed, it will likely drive up the stock's price because it represents a substantial demand for that stock. Self-interest. With this anticipation in mind, the broker may decide to take advantage of the situation for their own gain. They might execute their own orders to buy the same stock at a lower price before the retail trader's order is filled. Objective. The broker's objective in doing this is to profit from the expected increase in the stock's price once the retail trader's order is executed. By buying the stock at a lower price in advance and selling it at the higher market price after the retail order is filled, they can make a profit. In essence, this illustrates how the broker uses non-public information about the retail trader's impending large order to execute their own trades strategically, aiming to benefit from the price movement caused by the retail trader's order. This practice is considered unethical and, in many cases, illegal, as it puts the broker's interests above those of their clients and undermines trust in the fairness of the financial markets. It explains how the broker aims to profit from front-running. Here's a more detailed breakdown. Profit for the broker. After the broker anticipates that the retail trader's order will drive up the stock's price and executes their own orders to buy the stock at a lower price, they are essentially purchasing shares before the retail trader's order is filled. Now, because of the retail trader's large order, the stock's price typically rises. The broker can then sell the shares they purchased at the lower price to the retail trader at the new, higher market price. This price difference between what the broker bought the shares for and what they sell them to the retail trader for represents their profit. Essentially, they are buying low and selling high within a very short time frame, capitalizing on the expected price increase caused by the retail trader's order. This practice is unethical and illegal in many jurisdictions because it allows the broker to profit at the expense of the retail trader, who ends up paying a higher price for the shares due to the broker's actions. It erodes trust in the fairness of the financial markets because it's not a level playing field for all participants. Algorithmic trading. Algorithmic trading. Institutions use sophisticated algorithms to trade quickly and at precise levels, taking advantage of less experienced traders who may not have access to such technology. Algorithmic trading. Algorithmic trading, also known as algo trading or black box trading, involves using computer programs, algorithms, to automate the process of buying and selling securities in the financial markets. These algorithms are designed to execute trades at high speeds and with precision based on a set of predefined rules and criteria. How big players exploit novice traders. Big institutional players, such as hedge funds or large investment banks, often have access to advanced technology and substantial resources to develop and deploy sophisticated trading algorithms. They can exploit novice traders through algorithmic trading in several ways. 1. Front-running. They can detect the trading activities of novice traders, such as large buy or sell orders, and execute their own trades just ahead of them. This allows them to benefit from the price movement caused by the novice trader's orders. 2. Arbitrage. Algorithms can identify price discrepancies between different markets or exchanges and exploit these differences by executing trades to capture small profits. Novice traders may not have the tools or speed to compete in these arbitrage opportunities. 3. Market making. Institutions can act as market makers, continuously quoting bid and ask prices and profiting from the spread between them. Novice traders who place market orders may end up paying slightly higher prices and receiving slightly lower prices when selling, benefiting the market maker. 4. High-frequency trading. HFT high-frequency trading algorithms execute a large number of trades in milliseconds, taking advantage of tiny price fluctuations. Novice traders may not be equipped to compete in this high-speed environment. Protecting against algorithmic exploitation. Novice traders should be aware of the presence of algorithmic trading in the market and take steps to protect themselves. Use limit orders instead of market orders to specify the price at which you want to buy or sell. Implement stop-loss orders to limit potential losses. Avoid engaging in highly speculative or illiquid markets where algorithmic trading is more prevalent. Consider longer-term investment strategies that are less vulnerable to short-term algorithmic price movements. By understanding how algorithmic trading works and taking appropriate precautions, novice traders can reduce their vulnerability to exploitation by big players in the stock market. Front-running in the context of algorithmic trading. Front-running. Front-running is a practice where big institutional players, like hedge funds or large investment banks, use their advanced technology and resources to detect the trading activities of novice traders. This detection typically involves identifying when novice traders are about to place large buy or sell orders in the market. Once these institutional players detect such orders, they quickly execute their own trades just ahead of the novice traders. By doing this, they essentially front-run the novice traders' orders. Here's why this can be advantageous to the institutional players. 1. Benefiting from price movement. When novice traders place large orders, it often causes price movements in the market. For example, a large buy order can drive up the price of a security temporarily, by executing their trades just ahead of the novice traders. The institutional players can take advantage of these price movements and potentially profit from them. 2. Reducing impact on their own orders. Placing a large order in the market can sometimes lead to unfavorable prices for the trader, as the market adjusts to accommodate such a significant order. By front-running, the institutional players can reduce the impact of their own orders on the market, potentially getting better execution prices. This practice can disadvantage novice traders because it can lead to them getting slightly less favorable prices when buying and selling securities. It's important for novice traders to be aware of front-running and consider using strategies like limit orders to specify the price at which they want to trade, which can help mitigate the impact of front-running by institutional players. Arbitrage. Arbitrage is a trading strategy that takes advantage of price differences for the same asset on different markets or exchanges. Here's a more detailed explanation. In arbitrage, traders or algorithms actively look for discrepancies in the prices of a particular asset, like a stock or a commodity, across different exchanges. These price differences can be caused by various factors, such as delays in information dissemination between exchanges or variations in supply and demand dynamics. The process typically involves the following steps. 1. Identifying price differences. The algorithm continuously monitors prices of the same asset on multiple exchanges. 2. Detecting opportunities. When the algorithm identifies a situation where the same asset is trading at different prices on different exchanges, it recognizes an arbitrage opportunity. 3. Executing trades. The algorithm then executes a series of rapid buy and sell orders to take advantage of the price difference. For example, if it detects that a stock is trading at a lower price on exchange A and a higher price on exchange B, it will buy on exchange A and simultaneously sell on exchange B, capturing the profit from the price gap. 4. Quick profit. Arbitrage opportunities often result in small, but almost risk-free profits because the price differences are usually very small and short-lived. These price differences can exist for just milliseconds. Big players with advanced trading algorithms can execute these arbitrage opportunities at lightning speed, capitalizing on these tiny discrepancies to make consistent profits. Novice traders may not have the technology or speed required to compete effectively in this environment, which is why they can be at a disadvantage when it comes to arbitrage trading. In summary, arbitrage is a trading strategy that exploits price differences across different markets or exchanges, and big players often use algorithmic trading to execute these trades quickly and efficiently. This can put novice traders' market making as one of the ways big institutional players can exploit novice traders through algorithmic trading. Here's an explanation. Market making. Market makers are financial institutions or individuals that continuously quote both buy, bid, and sell, ask, prices for a particular security or asset. They aim to profit from the spread, which is the difference between the price at which they are willing to buy a security, the bid price, and the price at which they are willing to sell it, the ask price. Market makers play a crucial role in maintaining liquidity in the market by providing a ready market for buying or selling a security. How novice traders are affected. When novice traders place market orders to buy or sell a security, they typically accept the prevailing market prices set by market makers. Market makers may adjust their bid and ask prices based on supply and demand dynamics, and they often aim to profit from the spread. This means novice traders who place market orders may end up paying slightly higher prices when buying and receiving slightly lower prices when selling, as compared to the more favorable prices that market makers offer to experienced or institutional traders. In essence, market makers can profit from the difference in prices between what they are willing to buy and sell a security for, and novice traders may unknowingly accept less favorable terms when trading with them. To protect themselves, novice traders can use limit orders to specify the price at which they want to trade, which can help avoid unfavorable price execution. High-frequency trading, HFT. Here's a more detailed explanation. High-frequency trading, HFT. High-frequency trading is a subset of algorithmic trading where computer algorithms execute a large number of trades in a very short period, often within milliseconds or microseconds. HFT relies on the ability to process vast amounts of market data at extremely high speeds and make split-second trading decisions to profit from small price fluctuations. These algorithms may employ strategies like market making, arbitrage, or statistical analysis to identify profitable opportunities. Novice traders may struggle to compete in this high-speed trading environment for several reasons. Lack of access to the advanced technology and infrastructure required for HFT. Inability to react quickly enough to capitalize on fleeting market movements. Limited resources to conduct the necessary research and develop sophisticated HFT strategies. HFT can introduce rapid and sometimes unpredictable price changes in the market, which can impact less experienced traders who may not be equipped to navigate such volatility effectively. In summary, high-frequency trading, HFT, is a form of algorithmic trading that involves lightning-fast trade execution and relies on exploiting tiny price fluctuations. Novice traders often find it challenging to participate in this high-speed environment due to the technological and resource barriers involved. HFT can contribute to market volatility, making it important for novice traders to approach such markets with caution and consider longer-term investment strategies. Pump and dump. Pump and dump, they can artificially inflate the price of a stock, pumping, enticing novices to buy, only to sell off their own holdings at a profit, dumping, and causing the price to crash. To avoid falling into these traps, novice traders should focus on education, risk management, and disciplined trading strategies. They should be skeptical of quick-rich schemes, use stop-loss orders, and consider a long-term investment approach rather than trying to time the market based solely on technical analysis. Additionally, seeking advice from experienced traders and staying updated on market news can be beneficial. Pump and dump. 1. Pump. This phase involves artificially inflating the price of a stock or asset. Typically, this is done by spreading positive, often misleading, information about the company's prospects. Novice traders and investors are enticed to buy into the stock based on this information. The goal is to create a buying frenzy and drive up the stock's price. 2. Dump. After the stock's price has been pumped up and inexperienced traders have bought in, the manipulators, often experienced or insider traders, start selling their own holdings at the inflated prices. This sudden selling pressure causes the stock's price to plummet. The key elements of a pump and dump scheme are: deception. Manipulators deceive others by promoting false or exaggerated information about a stock's potential, making it appear like a great investment opportunity. Timing. They carefully time their buying and selling to maximize profits. They start buying the stock before promoting it and sell when the price is high due to the increased demand they created. Victims. Novice traders and investors who are lured into buying the stock during the pump phase become the victims as they end up holding shares that lose value rapidly during the dump phase. Pump and dump schemes are illegal in most jurisdictions, as they manipulate markets and harm unsuspecting investors. To avoid falling victim to such schemes, it's important for traders and investors to conduct thorough research, verify information from reliable sources, and be cautious when encountering aggressive stock promotions or tips from unknown sources. Additionally, using stop-loss orders can help limit potential losses in case a stock's price suddenly declines. Let's delve into each key element of a pump and dump scheme in more detail. 1. Deception. Promotion of false information. Manipulators deliberately spread false or exaggerated information about a particular stock. This information often includes claims of massive potential profits, groundbreaking developments, or insider tips. Creating hype. The goal is to create hype and excitement around the stock, making it appear as if it's a fantastic investment opportunity. This false hype lures unsuspecting investors into buying the stock. 2. Timing. Strategic buying. Those behind the scheme typically begin buying the stock before they start promoting it to the public. This ensures that they acquire shares at a lower price. Selling at peak. Manipulators wait until the stock's price has been pumped up through their promotional efforts, which increases demand and drives up prices. They then start selling their holdings at these inflated prices, reaping significant profits. 3. Victims. Novice traders and investors. The main victims of pump and dump schemes are often novice or inexperienced traders and investors. These individuals are enticed by the misleading information and buy into the stock during the pump phase. Holding losing positions. Unfortunately, these unsuspecting investors are left holding shares that rapidly lose value during the dump phase. This can result in significant financial losses for them. It's important to note that pump and dump schemes are illegal because they manipulate markets, defraud investors, and harm market integrity. Regulators and authorities actively investigate and prosecute individuals or groups involved in such schemes. To protect themselves, traders and investors should be cautious when encountering unsolicited stock tips, especially from unknown or unverified sources. Thorough research, verifying information from credible sources, and using risk management tools like stop-loss orders are essential strategies to avoid falling victim to pump and dump schemes in the financial markets. Let's elaborate on the first key element of a pump and dump scheme, which is deception. 1. Promotion of false information. False positive information. In this phase, the manipulators actively spread positive but untrue information about a particular stock. This information can include claims such as the company is on the verge of a groundbreaking discovery, has secured a major contract, or is about to release game-changing products or financial results. Misleading analysis. Manipulators might use manipulated financial data, charts, or technical analysis to make it seem like the stock's price is about to skyrocket. They may even create fake news articles or press releases that support their claims. Fake insider tips. Sometimes, they pose as insiders or claim to have access to privileged information. They use this false credibility to suggest that they have exclusive knowledge about the stock's imminent rise in value. 2. Creating hype. Social media and online forums. Manipulators often utilize social media platforms, online forums, and chat groups to disseminate their deceptive information. They may create multiple accounts or use fake profiles to post positive comments and endorsements about the stock. Email campaigns. Pumpers may also send mass emails to a wide audience, touting the stock as a once-in-a-lifetime opportunity. These emails can contain enticing language and visuals to capture the attention of potential investors. Boiler room calls. In some cases, pump and dump operators hire telemarketers to make high-pressure sales calls to potential investors, pushing them to buy the stock immediately. The ultimate aim of this deception phase is to generate excitement and FOMO, fear of missing out, among investors. When enough investors believe the false information and start buying the stock, it leads to an increase in demand, which drives up the stock's price. This artificially inflated price is the pump part of the scheme. As a result, novice traders and investors, who are often less experienced and more susceptible to persuasive tactics, are drawn into buying the stock in the belief that they are making a smart investment. However, they are unaware that they are falling into a carefully orchestrated trap, as the manipulators are already planning the dump phase, where they will sell their shares at a profit, causing the stock's price to plummet. Timing. 1. Strategic buying. Manipulators behind a pump and dump scheme strategically time their buying of the targeted stock. They typically start acquiring shares before they initiate their promotional campaign to the public. This early buying phase is crucial because it allows them to accumulate a significant number of shares at a relatively low price. 2. Creating the illusion of demand. By owning a substantial number of shares, these manipulators can create the illusion of demand for the stock. When they begin promoting the stock with false or exaggerated information, their early ownership gives the impression that there's genuine interest in the stock. 3. Driving up prices. As they continue to buy more shares during the promotion phase and attract other investors, the increased demand for the stock drives up its price. This price increase can lead to a self-fulfilling prophecy, as more investors, often attracted by the rising price, jump on board. 4. Selling at peak. Once the stock's price has been significantly inflated due to their promotional efforts and the influx of investors, the manipulators start selling their own holdings. They do this at the peak of the stock's price, maximizing their profits. 5. Exiting quickly. Timing is critical for these manipulators. They must exit their positions swiftly during the pump phase to ensure they profit before the inevitable dump phase occurs. If they hold on too long, they risk losing their gains as the stock's price collapses. It's important to understand that the manipulators in a pump and dump scheme are often experienced traders or even insiders with knowledge of the stock. They use their understanding of market psychology and timing to exploit unsuspecting investors. This is why novice traders and investors are particularly vulnerable to falling victim to these schemes. To protect themselves, individuals should be cautious when encountering sudden stock promotions that promise extraordinary gains, especially if they come from unknown sources. Conducting thorough research, seeking advice from trusted financial sources, and using risk management tools can help investors avoid the pitfalls of pump and dump schemes. Victims. 1. Novice traders and investors. Lack of experience. Novice traders and investors often have limited experience in the stock market. They may not have the knowledge or skills to recognize the signs of a pump and dump scheme. Vulnerability. Due to their inexperience, these individuals are more susceptible to falling for the deceptive tactics employed by manipulators. They may not fully understand the risks involved in such speculative investments. Holding losing positions. Buying during the pump phase. Novice traders and investors are enticed to buy the stock during the pump phase when the price is artificially inflated. They do so based on the misleading information and the fear of missing out, FOMO. Losses during the dump phase. When the manipulators start selling their shares during the dump phase, it triggers a sudden and sharp decline in the stock's price. This leaves those who bought during the pump phase with holdings that rapidly lose value. Financial consequences. As the stock price plummets, these victims may incur substantial financial losses. In some cases, the losses can be so severe that it wipes out a significant portion of their invested capital. Psychological impact. Emotional distress. Experiencing a significant loss in the stock market can lead to emotional distress, including stress, anxiety, and even depression. Novice investors may not have the emotional resilience or coping strategies to deal with such losses. Loss of trust. Falling victim to a pump and dump scheme can erode trust in the financial markets and deter individuals from future investment opportunities, potentially missing out on legitimate opportunities for wealth creation. To protect themselves, novice traders and investors should prioritize education and due diligence. They should be skeptical of unsolicited investment advice, especially if it comes from unverified sources or promises unrealistically high returns. Using risk management tools like stop-loss orders can also help limit potential losses in case the investment turns sour. Additionally, Seeking advice from experienced investors or financial professionals can provide valuable guidance and help avoid common pitfalls in the world of trading and investing.